Most people who put money in a fixed deposit sleep peacefully at night, believing their money is completely safe. For years, that belief felt incredibly true. You walk into your local branch, hand over your hard-earned savings, and walk out with a stamped paper that feels like a solid guarantee. But there are hidden limits to that safety that almost nobody talks about, including major new banking rules rolling out in 2026. This explainer is going to uncover the exact risk factors that can quietly hurt your savings when you need them most. Question yourself, do you actually know what happens behind closed doors at your bank once you hand over your cash? We all love the idea of zero risk when it comes to our money. We really want to believe that placing funds in a local bank is a perfect guarantee. It feels like locking your cash inside a giant steel vault where nothing can ever touch it. But the truth is, safety in money matters is almost never a perfect zero-risk promise. The goal today is definitely not to cause panic or worry. Instead, it is to bring real financial awareness into your daily life. Because when you finally understand the gap between how safe you feel and the actual risk your money takes, it gives you more peace of mind, not less. Now that we understand this, let us look at something equally important. Let us talk about the big gap between comfort and safety. Comfort is simply feeling good because you have a formal receipt from a trusted place in your neighborhood. You see the bank logo and you feel relaxed. Safety is entirely different. Safety is when you truly know the math and the rules backing up that piece of paper. You are not just locking money in a secure box at the local branch, waiting for it to gather dust. You are actually taking part in an active business process. Research points to the fact that most people never realize they're actively doing business with their bank. Question yourself, are you trusting a feeling or are you trusting the actual math? We are now moving into our first main area, the fixed deposit illusion. Let us look past the friendly smiles at the front desk and uncover the basic mechanics of where your money actually goes. This is where most people get confused, because we are taught from a very young age to view banks as giant concrete storage boxes. But a modern bank is not a storage unit. It is a highly active machine. When you open a fixed deposit, you are not putting money in a vault. You are actually acting as a lender. You lend your money to the bank. The bank takes your funds and issues loans to home buyers, to small shop owners, and to large businesses. It is basically a giant chain of promises. You promise to leave your money there, the bank promises to pay you back your principal, plus interest, and the borrower promises to pay the bank. To say it another way, your money goes out into the world to work. For example, your deposit might literally fund the new bakery down the street. But question yourself, what happens when that chain faces sudden economic stress and those borrowers simply cannot pay the bank back? Because those chains of promises can break, governments step in to offer deposit insurance. This is a massive safety net that prevents daily panic in the banking system. It gives people faith that the entire system will not collapse overnight. However, this safety net has very strict borders and sharp edges. It absolutely does not cover every single coin you own forever. Many people find this out the hard way. Here is how different parts of the world handle this boundary. In India, the DICGC covers up to 500,000 rupees. In the United States, the FDIC covers $250,000. And in Europe, the DICGC covers 100,000 euros. Notice that these are very strict ceilings. The government will protect your money exactly up to that number and not a single penny more. The amount above that ceiling is at severe risk if the bank fails. Question yourself, do you know your local limit by heart? Let us focus closely on the local Indian limit of exactly 500,000 rupees. That is the magic number for total safety per person in a single bank. But here is the vital detail that shocks many savers. That limit counts all of your accounts together. It combines your daily savings, plus your fixed deposits, plus your recurring deposits. Let me say that differently. Your entire relationship with that one specific bank is capped at 500,000 rupees. For example, if you have 200,000 in savings and 400,000 in fixed deposits, you are over the limit. Question yourself, have you ever added up all your balances in your main bank to see if you have crossed that legal safety line? We have covered a lot so far, but the most important part is coming right now. Stay with me because what comes next can completely change the way you think about money. Here is a common and highly dangerous trap. People often assume that if they hold 4 different deposit receipts, they get 4 different insurance coverages. That is completely false. The insurance limit is strictly per bank, not per receipt.
If you have 5 fixed deposits of 200,000 rupees each in the exact same branch, you only have 500,000 of insured money. The other 500,000 is unprotected. This is a vital mistake middle-class savers make every single day. Let us see how this connects to everyday life.
This brings us directly to bank health. Not all banks are equally strong. In the past, we have seen deep stress in cooperative banks and small finance groups where savers could not access their cash for months. Because of this reality, regulators are rolling out tighter rules starting in 2026. These stricter capital requirements aim to prevent bank failures, meaning weaker banks are under heavy pressure right now to clean up their books. You absolutely must verify a bank's basic health before trusting them with large sums of your money. Now that we understand this, let us look at another hidden threat. This brings us to the next important area, the silent risk of inflation. Inflation. Let us talk about the invisible force that quietly eats your money from the inside out, even if your bank never fails. This is something most people never find out until it is too late. You might think your money is completely safe because the number on the screen never goes down. But safety is not just about the number staying the same. It is about what that number can actually buy you in the real world. The crucial point here is knowing the clear difference between two very important numbers. Nominal, NOMINAL, return is the rate the bank advertises in giant bold letters, like 7%. Real return is what you actually get to keep after you subtract the living cost increases. To put it another way, real return is your actual buying power. If your bank pays you 7%, but the daily cost of food and rent goes up by 6%, your true gain is only 1%. For example, if you buy groceries today, next year those same groceries cost 6% more. Over a 10-year period, that tiny real return severely limits your future ability to buy things. Question yourself, are you chasing the big number on the poster or the real number in your pocket? Now we need to look at a real-life wake-up call. Let us look at the actual human cost of blind financial trust. This story shows exactly what happens when theory meets reality, and why trusting a single bank with everything you own can turn your life upside down in a matter of days. We often think banking freezes only happen in movies, until it happens to someone close to us. Consider James. James is a hardworking guy who wanted the best for his family. In year one, he deposited his life savings of $800,000 into one single regional bank. He did this just to get a slightly higher interest rate, maybe 0.5% more than the big banks offered. He thought he was being smart. Fast forward to year 17. The regulator found bad loans, restricted the bank operations, and James found his funds completely frozen right when he needed to pay for a medical emergency. He could not withdraw a single penny. It was terrifying. By year 18, he slowly recovered his money, but the heavy stress changed him deeply. In year 19, he drastically shifted his habits. He started spreading his money across several different banks, and he laddered his deposits. Question yourself, would your family survive a sudden freeze on your main bank account? This leads us to our active deposit management guide. It is time to shift from being a passive holder to an active manager of your financial future. Leaving your money on autopilot is one of the most common mistakes you can make. Let us break down exactly how to take control back with a few simple, powerful daily habits. First, we absolutely must bust a few common money myths. Myth number 1 is that fixed deposits are perfectly risk-free. The facts clearly show us that safety is never binary. It is a sliding scale of risk. A massive global bank is very low risk, but a tiny local co-op offering 1% extra interest is much higher risk. Spreading your cash out slightly takes away the deep fear of a single failure ruining your safety net. Myth number 2 is that bigger interest always means bigger wealth. Actually, taxes and inflation often wipe out that tiny extra gain. Question yourself, are you taking on hidden risk just for a few extra coins? The single best tool you can use right now is deposit laddering. Instead of locking one giant lump sum away for 5 long years, you break it down into smaller pieces. You divide your money. You set one piece to finish in 1 year, you set another piece to finish in 2 years, and another in 3 years. This simple habit gives you regular access to your liquidity if an emergency strikes, and it allows you to adapt smoothly to changing interest rates. This is a game changer. Let us look at exactly how to build this habit into your life. Let us walk through exactly what you need to do today. Step 1. Treat the exact insurance limits as a hard boundary line for any single bank. Never cross that line. Step 2. Verify the health of the bank by checking central bank reports online. Step 3. Always calculate your real return by subtracting inflation from your interest rate. Step 4. Ladder your maturity date so your money comes back to you in planned stages over time. If you follow these 4 steps, studies suggest your financial resilience will grow significantly. You will never be caught totally without cash. Question yourself, which of these steps can you start working on this afternoon? You also need to drop a few highly risky habits right away. Never place amounts far above the legal safety limit in just one single bank. Stop chasing a tiny 1% higher interest rate blindly at weaker banks. The extra cash is almost never worth the sleepless nights. Do not lock your vital emergency funds in long-term holds where you will face heavy penalty fees to get them out. And finally, stop ignoring tax implications and mindless auto renewals without checking if the deal is still actually good. For example, a teacher named Sarah used to let her deposits auto-renew for 10 years, losing thousands to inflation before she finally started managing her dates actively. Her buying power improved the very next year. The key takeaway here is separating the emotional comfort of a fixed deposit from its true practical function. It is perfectly fine to appreciate the steady nature of these accounts. We all like stability, but they are financial tools, not magic blankets that protect you from the world. You must keep clear records, stay informed about changing banking rules, and combine that stability with an active and clear mind. That is how you achieve true capital preservation over a lifetime. Your financial freedom is not a destination you arrive at one day. It is a direction you choose every single day. Small awareness, small choices, small habits, they quietly add up to something much bigger than you realize right now. If this gave you even one useful thought, share it with one person who needs to hear this. That one share can bring this awareness to someone silently struggling, and it helps Money Geeks reach more people who truly need this. Like this video and subscribe to Money Geeks. If this brought real value, look for the join button next to the Money Geeks logo below this video. Click it and become a member of the Money Support Circle. Your support gives Money Geeks the strength to keep going. Thank you so much for watching.